Hi, and welcome to SIOR Live. I'm John Silvestri here at the show floor of the SIOR Spring Global Conference in Scottsdale, Arizona. And I'm really happy to have as my guest Dirk Mosis of USAA Real Estate. Dirk, thanks for coming by.
No, thank you very much.
Really appreciate the time.
No, absolutely.
Where are the hot markets now for USAA? How do you define them?
The hot ones that come up on our research group, the four names that keep coming up, Raleigh, Nashville, Salt Lake City, and Oakland Bay East.
East.
They just east. So because of the peninsula and what's happening in the city there, that it's too expensive, so people are moving east, and it's livable. It's more affordable.
Right.
But in those four instances, educated workforce, growing workforce, but those are really secondary type cities.
Right.
You know, when you think about it, but. Very strong job growth, demographics, younger people that are going there. And those communities have done a lot infrastructure-wise to encourage, brains to be there. And those are all, to a certain degree, tech-related, medical-related in Nashville, obviously, but there's a technology aspect to it. Great workforce in Salt Lake City, a lot of back office call center. Not as much tech, but an educated, reliable workforce. It's kind of interesting.
It's interesting because I was just doing an interview with someone the other day who's focused in Boston, and you could be describing Boston for the tech base, the diversity, the workforce, the youth. So with USAA's firepower, why isn't there more of a focus on the primary markets?
We look there a lot, we try a lot, but the dollar per square foot, the cost, it gets very competitive, and that is primarily foreign capital that comes in either to buy existing and even on development, but a lot more on the acquisition, and their cost of capital is just less than ours. Relative, they're doing better here in the United States than what they would be doing back in their home country, so they're putting more here. And then it's just tough for us to compete because the returns that we need to give to our parent, USAA, need to be really more true core plus. And that gets to be super core. When you look at the Boston, New York, San Francisco, primarily, less so D.C., you can still find attractive returns. Right. Los Angeles, Chicago, yes. We are active in Chicago as a major market. Mm-hmm.
But you just did something in Manhattan.
Yeah. Yes, we just acquired two buildings, Manhattan, 46th and Broadway, plus or minus, and then we have one multifamily for rent on West 44th that's going forward. That's doing very well. And our Admiral Fund, our value add fund with David Robinson, the basketball player that we have with David. David has just acquired value add multifamily there in Manhattan as well. So we've been somewhat successful, but we'd like to do more there. And for me, a lot on the office development. I'm always thinking office development. Right. It's not all I do, but that's my primary focus. It's just a challenge to get into those really gateway markets.
The Salt Lake City characteristics that you ticked off before that I said were similar to Boston, is that pretty much a formula? Is that what you look for? Certainly in Raleigh-Durham, it's true. Is that true in the Austins and in the San Antonios? And
it's a great question. We do, but if you look right now at finance and at technology and energy, major drivers, energy's taking a hit, but it'll come back. If you go into any of those office buildings, and we do it, we've done build-to-suits, or we've done office buildings where they come lease from us. If you were to walk onto a floor and look at the occupants, the tenants, the people that are actually working there, there's huge similarities. There is so much programming and computer program coding development. It just so they could be doing a game or financial or energy horizontal drilling.
Right.
So in those instances, it is really brain power that you're looking for. Here in Tempe, you look at what State Farm is doing there. They're doing Atlanta and Richardson, Texas. There's technology, but there's also call center, both of them. And so what did they get in each of those markets? they had the primarily it's the demographics that they find. And USAA, our parent, is similar. We're very focused here in Phoenix, San Antonio, our home office, but also North Dallas, and we're doing a build-to-suit for them in Tampa, a call center. That call center, it's not so much high technology, but take very good care of our employees there, and it's a good employee base. And Tampa, it's not one of those other cities, but it's not as technology oriented as the other ones. But you still have a need for call center, so a little different, product type.
Is underwriting starting to be problematic? I've heard people say yes. I've heard people say no. What do you say?
We'd say we don't think it's problematic at all if we're selling something today, but when we're trying to compete, for our capital goes to a developer for ground up a development, and we've seen a couple markets where really the pricing for a speculative office building, what someone is willing to give them is problematic for us. Not because I lost the deal, but because it just doesn't make sense.
Right.
The returns it's too risky for somebody to be saying they're going to give that.
Yeah.
And
are you seeing more of that type?
We're seeing more, and it's really in the last 3 months. And we're in the markets every day, everywhere.
Right.
But we're just seeing it more now. The institutions have been able to sort of keep people kind of in the box. The banks, life companies. But what you're seeing, you see it in some of the non-traded REITs, because they can't buy and get the returns they need for existing, so they're going after the to-be-built buildings to put their money out.
Right.
That's risky.
Yeah.
When you're looking to say I'm giving a dividend to someone, that gets to be risky. And then also, I would say that on development, the foreign capital isn't as aggressive. They won't take that kind of risk, but for finished product, they will or almost finished or significant lease.
Right.
We think they're overpaying, but I would say it is not what it was in 06, 07. It's not that irrational. It is not that. But
and I wasn't implying
no. I didn't mean to. But when I start hearing myself talk like that, but we see a couple of anecdotes, and so then is that going to be systematic, or is it a one-off in a hot market somewhere? I'm not quite sure. And yet, if someone can still buy something at a 5 and get 3% debt on it, 3.5%, even 4, why not? Right?
Yeah.
There's still that kind of spread between the cost of debt and the equity. So maybe it's not. Just a couple of these deals have just seemed a little bit overly aggressive, just trying to make a deal. And when you start getting into financial structuring to make your deal, as opposed to having true people that are going to be in the building, tenants that pay rent, I think that's a formula that I've been doing this 30 plus years, and you've seen it about 4 times, and you start to see it again a little bit.
Exactly.
So,
does it put an asterisk on your outlook?
I'd say we're cautiously optimistic across the board. You just have to look at each zip code in Maine and Elm, wherever you're looking at.
Right.
Still
a local business.
Yeah, it's still a local business, and that's the great thing with the SIOR guys, because they're all local.
Right.
They know the market at that Maine and Elm, and that's what's so important to our capital, because we can't be there day in and day out.
Right.
So that's why we rely on these guys to steer us in the right direction. So I'd say just overall, coast to coast, we're optimistic, but we are probably not acquiring as much as what we'd like, because we're getting outbid, but so be it.
So be it.
Yeah.
It is the way you seem to have a good track record, and
it's great when you've got the members' money, and you know that the owner, being a member, an individual of USAA, and his or her face is on a dollar. You're going to do the right thing when you spend it and when you invest it. And then we generally have been fortunate and blessed that we are we don't have to sell and we don't have to invest. So
exactly
that, if you have that, and that gets back just to basic fundamentals of keeping it low leverage and being in it for the long haul, and especially on the office, because office is a timing play.
Yeah.
Everything lasts so long. It's more of a timing play. Apartments, you can dial that rent up and down. Industrial, it's a shorter time period to get the thing built and leased. Office, you got to be ready for the long haul, and so that's not for the faint of heart. So we've been fortunate in that regard.
When you don't have to buy and you don't have to invest, you can be smart.
We can be smart about it and make sure everybody's money, our development partners and everybody else is, and our partners, our investment, partners, because most things we do have co-investors. So, yeah.
Great way to end.
Good.
Dirk, thank you so much for your time.
Thank you very much.
And I want to thank you for joining us on Globe Street TV.